reports are causing a stir. The average 30-year mortgage rate in the United States has climbed to over 7.6%, a peak not seen since December 1st, 2000. This development paints a rather grim picture, leading many to question the stability of the housing market. What began as a minor concern has escalated into one of the largest asset bubbles in financial history. Understanding the journey to this point is crucial, as it not only explains the present situation, but also signals alarming warnings about the future of this volatile economy. The impending housing market crash is predicted to be the most severe ever witnessed. To understand why, a look back at history is essential, highlighting clear evidence that current trends are highly abnormal. When analyzing housing prices over time, many people reference charts that display historical price trends. However, these charts often omit a critical factor: the impact of inflation over several decades. The influence of inflation is frequently underestimated. For instance, a house bought for $200,000 in 2000 may seem like a bargain, but when adjusted for inflation, that amount equates to approximately $356,000 in today's money, 2024. This means that, although on paper the value seems to have increased, in reality it may not represent a genuine financial gain. To accurately assess the existence of a housing bubble, it's crucial to factor in inflation and truly understand the extent of the increase in home prices. For this purpose, the inflation-adjusted Case-Shiller Index is utilized, which presents the real value of home prices, eliminating the misleading effects of a depreciating dollar. Currently, this chart reveals that home prices have exceeded the levels of the previous bubble, which was a significant event in U.S. history. The comprehensive research conducted by Robert J. Shiller and Carl Case provides us with reliable data on housing prices dating back to 1889. The data clearly shows the extraordinary spike in 2008, where housing prices reached what was once deemed an unattainable level. Although there has been a general trend of increasing real prices over the past century, the current situation indicates that today's bubble is even more severe than the one experienced in 2008. While price trends up until around 2012 can be considered normal, the market has since deviated significantly from this norm. Why do I believe we're heading towards a repeat of past market crashes? The crux of my argument hinges on a historical perspective, particularly regarding interest rates. It wasn't entirely unexpected to witness the development of the 2008 bubble following the year 2000. The key factor here was the trajectory of interest rates. Historically, interest rates have been high by today's standards, but over the past 30 years, there's been a gradual decrease. This decline set the stage for the formation and eventual collapse of the 2008 bubble. However, the real lesson wasn't learned then. Post-2008, the Federal Reserve continued to drive down interest rates to record lows, reaching around 2.6% at one point, inadvertently fueling a new bubble. From late 2011 to the present, the real, inflation-adjusted price of homes has surged by 66%. Excluding the rise leading up to 2008, such a rapid increase in housing prices is unprecedented in the U.S., and historically, each instance of such acceleration has led to a market crash, realigning with long-term averages. If the data presented so far doesn't fully convince you, there's another set of evidence that, in my view, serves as the definitive indicator of an impending market correction. This evidence strongly suggests that a significant shift in the market is inevitable. The connection between the housing market and interest rates is crucial, especially considering that most purchases and investments in this market involve some form of loan, typically a 30-year fixed mortgage. To delve a bit into the mechanics, the 30-year fixed-rate mortgage is essentially linked to the 10-year Treasury note. In essence, this financial instrument significantly influences mortgage rates. Now, you might wonder, how does this relate to the value of your home? To address this and solidify the argument, it's important to grasp some context. Picture a 10-year Treasury note as a unique type of bond through which the government borrows money. The process is straightforward. The government takes your money and promises to return it with an added interest after 10 years. As of now, the interest rate paid on these notes is 4.5%. Understanding this relationship is key to comprehending how fluctuations in these rates can impact mortgage rates and, consequently, the housing market and the value of homes. Here's where the scenario becomes particularly intriguing. Alongside the 10-year Treasury note, there's also a 2-year Treasury note, which currently offers an interest rate of 5.02%. This is unusual because it means the government is paying a higher interest rate for borrowing money over a shorter period, 2 years, than over a longer period, 10 years. Normally, the expectation is the reverse. Longer borrowing terms typically attract higher interest rates. When we observe this kind of inversion, where short-term rates are higher than long-term rates, it leads to what's known as an inverted yield curve. In simple terms, an inverted yield curve is a strong indicator of an impending recession. Historical patterns demonstrate that almost every time the yield curve inverts, the line dips below zero, a recession follows. This pattern held true in the early 1980s, early 1990s, early 2000s, 2008, 2020, and it appears to be happening again now. The 2022 chart shows a significant inversion, and even though the rates are beginning to ascend back into positive territory, this is not necessarily a sign of good news. Contrary to what some might think, the emergence from an inversion doesn't typically signal the avoidance of economic downturn. Rather, recessions often start after the inversion phase ends and the yield curve moves back above zero. The 2008 financial crisis is a prime example, where the most severe impacts were felt years after the initial inversion. Currently, we're in a precarious position. The Federal Reserve is aggressively raising rates, but the bond market seems to be challenging their strategy. This tension between the Fed's actions and the bond market's response is a critical aspect of my forecast for an upcoming market crash. The current state of the bond market, particularly the similarity in yields between the 30-year and 10-year treasuries, suggests that investors are bracing for significant inflation in the future. This inference is drawn from the fact that, under normal circumstances, a rational investor would gravitate towards the 30-year treasury if it offered a more attractive rate. However, the rate isn't enticing enough due to the prevailing uncertainty about the upcoming years. This situation allows the 10-year treasury to sell at a similar yield because it needs an appealing incentive to attract buyers, especially when its rate is considered in the context of the 30-year yield. For those who might find this concept complex, the key takeaway is that these treasury yield trends indicate investors' expectations of continued high inflation. Considering this, one must ponder the implications if the Federal Reserve continues to hike interest rates to combat this inflation. To see a resurgence of inflation, the Fed would need to reverse course, a scenario typically precipitated by a crisis. The looming crisis is becoming increasingly evident: the potential collapse of the housing market, driven by these interest rate dynamics. Rates, in this sense, act like a gravitational force, and as we venture into uncharted territory, the risk increases that a significant disruption could trigger a collapse of the extensive, fragile structure that has been building since 2012. In this context, the bubble we previously considered the largest may seem minor in comparison to what could unfold. Before concluding, let's consider the impact of the looming housing market crash on homeowners and investors. The implications extend far beyond rising interest rates and the potential for economic downturns. They significantly affect everyday people and savvy real estate investors. Homeowners with adjustable-rate mortgages or those planning to refinance could find themselves grappling with increased monthly payments due to higher interest rates. This situation may lead to a rise in foreclosures, flooding the market with homes at substantially reduced prices. Investors, particularly those who purchase properties under the assumption that their values would continuously increase, will encounter difficulties as property prices fall. They might find themselves in a position where their properties are valued less than the remaining mortgage balance, coupled with a decrease in rental income.